Debt has been piling up all around the world, and we see the same policies being applied, and that is quantitative easing or some sort of stimulus package and low interest rates. And we are seeing that this hasn't fixed anything in the economy whatsoever. And I would suggest that it gets even worse when we look deeper into the reality and realize that we're using their statistics to determine the fact that this is a failure. But what about what lies in the shadows? What about that data which is behind the scenes? Well, this is one thing we'll get into today. Shadow banking, the $75 trillion nightmare. You came here for the truth, so let me unveil that for you today. This is the Financial Stability Board bringing the information directly to you, and they conducted yet another one of their studies here, and they found this. The broadest measure, referred to as the monitoring universe of non-bank financial intermediation, grew by $5 trillion in 2013 to reach $75 trillion. This is what they're saying here, that the shadow banking has totaled up to $75 trillion. In fact, that is now 120% of the GDP of the world. Again, something that cannot be paid back. So let's get into more detail about what exactly shadow banking is. For those who don't know, let's go into this here out of Bloomberg. All of this increase was driven by the lenders seeking to skirt regulations and investors searching for yield amid record low interest rates. As I mentioned at the beginning of the video, they've pushed these policies on us, and they have these low interest rates, which is forcing investors really to look elsewhere rather than the conventional investments, let's say, and they are choosing to go into these high risk investments. So let's look at what they said. The size of the shadow banking system, which includes hedge funds, real estate investment trusts, and off-balance sheet investment vehicles, is about 120% of global GDP. That off-balance sheet investment is something that has been really taking over in recent years. You look at things like these over-the-counter derivatives, you look at the asset-backed securities, collateralized debt obligations, credit default swaps. These items never make it onto their own statistics, their own balance sheets, because of course that would mean that they would instantly be a failure. So they keep it off the books, and all of the politicians, all of the financiers, all of the bankers, all of the technocrats are allowing this to happen so that their schemes can continue. But when you look at the stock market, when you look at talk to the traders, when you talk to those in the finance industry, you find that they completely ignore this information. Simply because their jobs are relying on it. Is quite really something to think about when you realize the risk, the fragility that is in this market. More information in the article if you want to read it. It's always down in the description below. This is out of the Wall Street Journal. Former Fed Chief Greenspan worried about the future of the monetary policy. Of course, you should be worried. In fact, I quoted him in my book talking about how he would be very skeptical of a QE3 because that would erode the value of the US dollar. And they engaged in it, and it's now over after printing more and more trillions of dollars, adding it to the books. And this is what he said. Former Federal Reserve Chairman Alan Greenspan said that the Fed's bond buying program, which aimed to lower unemployment and spur economic growth, fell short of its goals. And once again, I've said this a million times, I'll say it once again. How can buying garbage somehow spur economic growth? It doesn't make a single ounce of sense. It would have made, and I'm not suggesting that they do this, it would have made a lot more sense to just hand a paycheck out to all of the individuals in the United States, and that would have gotten the economy going much better than printing it and giving it to foreign banks all around the world. That was a huge mistake, but of course, that wasn't the intention in the first place, to get the economy going. Out of Bloomberg once again, the Prime Minister of Japan said that the yen depreciation is hurting small companies and households almost 2 years after triggering the currency slide, with a call for unlimited monetary easing to end deflation. As soon as they said that they would print to infinity, and the reason they wanted to do this was to end their deflation, it started to trigger this currency slide. Well, this is quite interesting here. They're going to print money to end their deflation, but this hasn't worked over these past few decades. They can barely keep up. All they keep doing is increasing the amount of money that they're printing. So instead of fixing the problems, allowing their banks to get out of their zombie mode, allow them to crash, and then allow real investment to take place. But that, of course, can never happen. It never will. And I'm trying to show you, by using Japan as that example, how it doesn't work. You're going to have to do QE 3, 4, 5, 6, 7, 10, 100, a million just to keep it alive, and that is barely alive. And this is the thing that I like to look at myself, something that I talked about in my book, something that I consult when I have my consultations. I talk about this with people and I stress the importance of it. Look at these numbers comparing from January 2000 to March 2014. Now, of course, these numbers fluctuate, but it just gives us something to look at. Over the past 15 years, essentially, you're looking at a barrel of oil going up 300%. You're looking at a dozen eggs going up 100%, ground beef going up 100%, movie tickets 100%, electricity is up, new cars are up, coffee, natural gas, postage stamps, and even the fake CPI number going up significantly. So what does this mean? This is your real life, because these are the things that you have to buy every single day. You may not be directly invested in the stock market, but that's rising. You look at everything is rising except for your wage. And that is what they don't understand. You call it, you're trying to fix this economy with a quantitative easing, but it doesn't translate. The Federal Reserve is doing this scheme in order to hand money over to the bankers, and it is working very well. A similar thing that I did, except this is from my book here, just showing you in a picture format how the dollars are losing their value over the years. And this is just rounded numbers. $100 bill in 1900 buying you a car, 1950 buying you a motorcycle, and the year 2000 buying you nothing but a bus pass. The dollar is still a dollar on that bill, but it is losing its value in terms of real goods. That's what they do not get across. In this chart here, I'm just showing you what just happened, and that is that the market is continuously breaking. It is constantly leaving people unable to trade. They're getting these problems. You have these completely computerized systems. You have the algorithms that are taking place, and it is constantly breaking. It is very concerning when this is going to affect the banks. We've seen it happen where people have not been able to pull their money out of the banking system, and this could happen intentionally, or it could happen as a result of a computer error. But when you have your money, when you have your savings, when you have your wealth inside of the system, you're taking that risk. This extends out into what's happening in Asia. They're seeing a problem and they are looking elsewhere, and you can see how China specifically is going and looking into other countries to do business with. They don't want to be part of what's been happening over these past few years. And right here, more of the currency war taking place. Singapore and China to start direct currency trading. Yet another other country that China is partnering with to have their currency war engaged against the West, and they are slowly but surely making these gains and basically changing the way they do business. They are slowly but surely engaging in this currency war, that is no doubt. But of course, China is not without its problems. This information out of Bloomberg: ICBC posts biggest jump in bad loans since 2006 on the economy. Further down in the article, they said non-performing loans rose 9% in the third quarter from the previous 3 months. And of course, this is a problem because the world economy is hurting. That's official. You look at it statistically. I showed you a few videos back how there were 9 charts showing how China's economy is hurting right now. But it's not just China. Look at who they're exporting to: Europe, and even in the US. And I just talked about how in other countries they had to bring the interest rates downward, even after suggesting that everything was just fine and we were on a recovery. We know that is not the case. All of the mainstream media statistics are either skewed or completely fraudulent. You have GDP numbers in the Eurozone accounting for things, illegal activity like prostitution and drugs. You know the economies are hurting when they have to do that, when they have to go that far out into this extreme region. If you found this video informative, I really would appreciate it if you give me a thumbs up. That helps me out a lot. It also signals to the other YouTubers out there that this information is good and it's valid. If you found this video informative, you would probably want to also get onto the Insiders. It's where I give out all my best intel for free, and that is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.